I recently met someone, I'll call him Joe, who paid thousands of dollars in taxes on dividends last year. Joe spent thousands of dollars in taxes on dividends earned in 2022. And that surprised me because dividends, qualified dividends, are taxed at a reduced rate, not your ordinary income tax rate. Therefore, it's essential that you make informed investment choices, or you may have hundreds or even thousands of dollars in unnecessary tax liabilities on dividends. In this video, I will explain the tax implications of investing, how investment income and capital gains are taxed, and some strategies to reduce your tax liabilities on investment income. But before we delve into the details, please pause and read this disclaimer carefully. If you don't know me, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Follow me to learn how to build wealth through investing. When you invest, there are two main ways to earn money. The first one is capital gains. Here's an example. Let's say you buy one share of Apple for $100 and sell it for $150. You earn a capital gain of $50. Your gain will be taxed at different rates depending on how long you hold on to your share of Apple. You don't get taxed on the entire sale price, just the gain portion of $50. If you hold on to your share of Apple for longer than a year, after which you sell it, the IRS classifies your gain as long-term capital gain taxed at a lower rate. You pay either 0%, 15%, or 20% of the gain in taxes. Let me explain. For the 2023 tax year, if you're a single filer with a taxable income up to $44,625, your long-term capital rate is 0%. If your taxable income is above that amount but up to $492,300, your long-term capital gain rate is 15%. A majority of our viewers fall in this category. If your taxable income exceeds that threshold, you pay a long-term capital gain tax rate of 20%. Some exceptional cases exist where tax filers may pay more than 20%. Examples include selling collectibles, small business stock, or real estate. If your status is married filing jointly, married filing separately, or head of household, this table should guide you on your long-term capital gains tax rate for 2023. So you would pay either 0%, 15%, or 20% in capital gains tax. The thresholds for 2024 tax year are slightly different as seen on the screen. Feel free to pause the video or return to the previous screen to see your tax bracket for 2023 and 2024. Now suppose you sell your appreciated share within 1 year of purchasing. In that case, your capital gain is considered short-term capital gain and will be taxed at your marginal income tax rate, which is typically higher than the capital gains tax rate. Now let's say the share of Apple that you bought for $100 goes down in price to say $70. If you sell your share, you will realize a capital loss of $30. You can use that loss to offset your taxable income up to a limit. Here are the exact steps to follow. Add all the short-term capital gains, then add all short-term capital losses. Net them out to get a net short-term gain or loss. Now add all long-term capital gains and add all long-term capital losses. Again, net them to get a net long-term capital gain or loss. Here are 5 scenarios that can occur. Scenario 1, you have both net short-term capital gains and net long-term capital gains. In that case, you would pay capital gains tax on long-term capital gains and ordinary income tax on short-term capital gains. Scenario 2, you have only capital losses. In that case, you can use up to $3,000 of losses to reduce your taxable income if you're married filing jointly, and $1,500 if you're married filing separately. If capital losses exceed $3,000, you can carry those losses to future years. Now, scenario 3. Net short-term capital gain exceeds net long-term capital loss. After you net the two, you are left with a short-term capital gain and pay ordinary income tax on it. Scenario 4. Net long-term capital gain exceeds net short-term capital loss. After you net the two, you're left with a long-term capital gain and you will pay capital gains tax on that amount. And finally, scenario 5, net short-term capital loss exceeds net long-term capital gain, or net long-term capital loss exceeds net short-term capital gain. After you net the two, you are left with a net capital loss, which you can use to reduce your ordinary income up to the limit and carry over the rest into future years. The second way you can make money through investing is by earning dividends, which Joe did in 2022. Remember Joe? We talked about him at the beginning of the video. Some companies pay shareholders dividends. These dividends may be annual, quarterly, monthly, or one-off. Dividends are of two types: ordinary dividends taxed at the ordinary income tax rate, or qualified dividends taxed at capital gains tax rate, either 0%, 15%, or 20%. Joe thought he was earning qualified dividends, but in reality, all his dividends were ordinary. Let's talk about what makes dividends qualified versus ordinary. Dividends paid by US companies or qualified foreign companies are qualified dividends. Dividends paid by REITs or real estate investment trusts are not qualified and are taxed at ordinary income tax rates. Joe's investments were in US companies, none of which were REITs. But there's a third criterion that Joe ignored, and many of us do. It's the holding period requirement. The IRS classifies a dividend as qualified if you hold the stock for at least 61 days in the 121-day period that begins 60 days before the ex-dividend date and ends 60 days after the ex-dividend date. So here's an example. Apple declared a dividend with an ex-dividend date of November 10. You would be eligible for the dividend if you bought Apple before that date. Now let's say you purchased Apple on November 1 and instead of holding it for 61 days, you sold it in 30 days. You would pay ordinary income taxes on that dividend amount. Let's say you are in the 30% tax bracket. Instead of 15% capital gains tax, you are paying the IRS 30% in taxes. For someone who earned $20,000 in dividends, you would pay the IRS $3,000 more than you would have by waiting 61 days to sell. Of course, by holding the stock longer, there is a risk of the stock price falling and you need to sell the stock at a capital loss. So you have to judge when you want to sell and whether you want dividends to be taxed at ordinary income tax rate or at a reduced rate. So here are some strategies that may help lower your tax liabilities on investment income. Reduce your taxable income. Lower taxable income puts you in a lower capital gains tax bracket, which is either 0 or 15%. You can lower your taxable income by increasing your contributions to tax deferred strategies such as IRA, 401k, HSA, etc. Use tax advantaged accounts to purchase dividend and interest producing assets. Buying dividend stocks in an HSA or Roth IRA may lower your taxable income if you use these accounts correctly. Thanks for staying till the end. Feel free to ask questions in the comments, but I also like words of encouragement, kindness, and constructive criticism if you have no questions. If you enjoyed the content and found it helpful, please give me a like and follow, and that will do for now. As always, don't forget to be happy, kind, and your best self. I will see you in my next video. Bye.